We talked about the interest rate hikes earlier. For more on this, Dan McClory joins us from Irvine, California. He's the managing director and head of China for Boustead Securities. Dan, good to see you again.
Hey, happy 23, Phil.
And to you as well, my friend. This statement today, this decision we made, pretty much as expected. I know there was some nervousness going into it. Any surprises for you?
No, I think it confirmed that markets like consistency. So it was sort of as predicted. There was a little bit of uncertainty leading up to Powell's announcement, but as soon as it hit, you saw the markets actually stage a comeback. Some of the best intraday rallies that have taken place since going back to last October.
I couldn't help but notice, though, leading up to this announcement, that the long-term Treasury yields, and I mean, let's do 10 years and further, really actually inched their way lower, meaning that many people are betting that at some point, either later this year or next year, that the Fed's going to reverse all these decisions. And they call this fighting the Fed, but that's exactly what a lot of people are betting on, including the stock market and probably the bond market as well. This seems to be a recipe for disaster at some point.
I mean, it sure could be. I mean, the best we can surmise from today is that March might bring a pause, not a reduction, but a pause. Inflation has not been tamed. We heard about it with, the effect that this rise is going to have on credit cards, student loans, automobile loans, home mortgages, everything else. So I think if we look to a pause or no increase in March, that would be a good thing. But remember, we've been through some 0.75 increases, 0.5 increases, now 0.25. Relatively speaking, we're starting to move in the right direction.
But what good does raising the short-term interest rate do other than hurt people who borrow money for short-term reasons? Most investment in this country and quite frankly around the world is made in very long-term decisions, borrowing a large amount of money for a long period of time. If those rates aren't moving up, then what the Fed's trying to do really isn't incentivizing or disincentivizing people to make long-term investments. I mean, I just think there's a huge disconnect there.
Without question, but obviously their top agenda is to get inflation under control. So that is the onward investment, stable long-term rates that encourage it, or reduced rates. That's really of far less importance. So there's a whole different agenda at play here. People are feeling it, at the pump, in the grocery store, everywhere else, and so they're really trying to address that. But to you and I, with our heads in the investment world and looking at how we want to see markets recover, it's certainly not going to help with that.
We've seen some encouraging news on inflation. So for sure, inflation at least seems to have reached its peak. So it has come down. However, the job market still remains relatively hot despite some of the tech layoffs that we've seen. Overall, unemployment rate is near a record low, and we just saw a fairly strong print on GDP as well. So if the goal is to slow down the economy, it doesn't seem to be having, at least right now, the intended effect. Is this something we're going to have to wait another couple of quarters to see the full impact?
Well, I think we saw that the manufacturing index was actually down. So that might just be supply chain catch up, but that's being backed off. Job growth was less than it was in the prior period. So maybe that was elevated. So that was slightly off. You're seeing some signs, not massive ones, but you're seeing some signs that this policy is working. But again, I'm with you with my head and my wallet in the stock market, whether it's IPOs or direct investing. This is not good for the stock market.
We saw the CEO of Redfin come out. Of course, they do all the real estate stuff online and listing all the big listings. The CEO came out and was actually relatively bullish, saying that the worst is over for this decline in the housing market, which is the one thing we were trying to bring down, right? We were trying to bring down rents and housing affordability. But if the worst is over and things are going back up again, the Fed, they can't control everything. But I'm bringing this up because now you're in a situation where people are going to, with full employment, people are still out spending money. And inflation, I don't see how it gets back to 2%. I just don't see a scenario barring some sort of recession.
No, and it's certainly people have backed off some degree of spending. It's not like it was 1 or 2 years ago, but it's going to continue to run in that direction, Phil. I think these longer term impacts that the rate rises have, that's one thing. But in terms of getting inflation, back to 2%, that's wishful thinking.
Yeah, nowhere do we see that. And now if you throw in there the fact that China is reopening, right, and the IMF and everybody else says, well, with China reopening, that's obviously good for the global economy. That's another, step in the on the gas that's going to push the economy forward even further and probably put more pressure on inflation, not just in the U.S. but around the world.
It very well could. I think the trade-off, which is hopefully economic expansion and growth, would outweigh that, and that can be seen as a good thing and inflation acceptable, but not if they keep hammering away at rates like they are, upward.
Real quick, what do we expect on the next rate decision, given what we heard from the press conference today?
No higher than today's, and perhaps, as I'm mentioning and I've read, a pause. So let's just keep it there. But probably not much more than a quarter point.
Dan, good to see you. Thank you, my friend.
Thanks, Phil.